Hey, good afternoon, everyone. Marty Mazzara here. It is Sunday, the 6th of April, 2025. This video hits your inboxes automatically at 11 a.m. in the morning. So obviously a lot can happen between now and then given current market dynamics. But based on what I'm looking at in terms of tomorrow's schedule, this is probably the best time for me to reach out and just give you a little more of our perspective on what's going on and keep you up to date on the events and the market implications and probabilities as we see them. As I speak, if the market were to open right now, the Dow would be down a little less than 1,400 points or 3.5%. The S&P would be down 4%. The NASDAQ and small cap U.S. stocks would be down almost 5%. Gold is selling off a little bit as well, down about 0.2%. Silver's down about 1 2/3%. Copper's down 5%. Crude oil's down 3%. Pretty much the whole commodity complex is selling off as well. Yeah, palladium down 2%. In terms of currencies, the dollar is tanking. I'm going to show you a chart here in a second against the yen, which is what we have been talking about for a long time now as being probable when the next bear market recession crisis occurs. Those of you who are interested in cryptocurrencies, Bitcoin is getting throttled, down 5.5%. And then bonds are rallying quite nicely. Longer-term treasuries, the 10-year treasury yield is down 2.71%. So what does all that mean, folks? It means that investors are de-risking, and this is global too. Non-U.S. stocks are taking similar hits as well. I talked last week about the likelihood any day now of a rip-your-face-off rally, and I said that over the weekend, if we got news that there were some constructive talks beginning and that maybe the administration was ready to already rethink some of these tariffs, that would be massively bullish for a day or three, right? We'd get this massive short covering, as I keep saying, rip-your-face-off rally. Well, not only has that not happened, the president and his advisors have really dug in their heels this weekend and essentially just said they are not remotely inspired to do anything differently in the short run. Make no mistake, if this keeps up in the market, that tune will change sooner than later, and I still suspect that, any hint, given the speed of the decline and the volume, any hint of positive news will have traders anyway rush back in. And by the way, these are the kinds of markets that traders love. Massive volatility, big price swings. They can play the swings. If they're good at the technicals, and that's typically what they have to rely on, they can play these swings profitably. And just to give you an update on the economy, or at least our assessment of it before we get to the charts. This is the PWA index, 43 economic data points, and as you can see, it is rolling over now quite noticeably at an accelerated pace. This just says that odds of recession are rising significantly as we speak. And as I've said a zillion times over the past couple of years, this market at these valuations is not remotely pricing in recession. And even after this decline, which we're going to get into here in a second, in a recession scenario, stocks go a lot further lower. So let's take a look at the charts, and I'll tell you what our technical analysis currently says. So what I have up here today at first is the NASDAQ 100 ETF. There's that bear flag that I drew as we were going through our first retracement of this pretty swift sell-off here last month. Remember, as this developed, I said probably to the 200-day moving average. If this plays out, then we're going to have a bear flag. And then it's the length of the flagpole will be our next target. And as you can see, that's at 422.67. So folks, right now, if we were to open where futures say we would, this would careen another 20 points lower. That would actually take us below what should be pretty significant support right here at about 413 on this particular ETF. So zooming out a bit, essentially the next line of resistance would be 400, pretty much right on the nose, and it looks like we could very easily hit that tomorrow. If that doesn't stick, then we're gonna find other areas of congestion in here that would serve as support. 383. These are 3, 4, 5% declines at a time before we find support on this chart. So it's looking very bear market-like, if you will. Now, if it were to hold up, and let me go back to the 1 year. If it were to hold up and bounce, maybe some overnight news from Washington before the market opens kind of stick saves it, then we would draw our Fibonacci lines right here, and we would look for a retracement first to 450, but very solidly up here at about 468 would be that 38% retracement, which is right where it died here after retracing about 38%. So we fully do expect some major rallies off of this very swift technical decline. We also have a base case that says probably entering the next bear market. And that means that while we should respect those rallies and maybe be tactical, as I mentioned, trying to take advantage of those rallies, you do not want to abandon your defensive posture in this environment. The 200-day moving average is rolling over, very negative sign. Price is below it. And the 50 looks like we could get a bearish crossover here over the next few days if this indeed continues. And I suspect that it will, as long as Washington stays as firm as they are on this tariff policy that is dramatically worse than virtually anybody had anticipated that it would be. Looking at the S&P 500 chart, we actually exceeded our bear flag target. And we're down here at about a little below 5,100. We were going to blow right through 5,000 tomorrow morning, folks, if the market opens where futures suggest it would open. And then the next legitimate probably area of support would be right here. You can see we hit this here, and then we hit it again here. Massive resistance here, resistance for a bit, and then it became, support just for a little while, and then never have seen it since. So that would be 46.57 on the S&P 500, and I would look for some pretty serious support along the way. If we didn't have the very threatening tone and the conviction coming from Washington on these tariffs, I would say that 5,000 would be pretty firm support, and it may be. We are going to see some pretty strong rallies, and I think probably sooner than later. But those, all things equal, would not be rallies to buy into expecting that the worst is over. Not given deteriorating macro conditions, as I just talked about in our own index, and just not given the global state of affairs. In terms of the momentum, and I didn't pull this up on the NASDAQ 100 ETF, but it's the same there. Right now, we do have somewhat of a bullish divergence on the MACD, on the moving average convergence divergence, meaning we have a much lower low, but we don't have a lower low. It's almost break even here on the MACD so far, and I've shown you these over and over again. These historically are pretty compelling setups for the market to go higher. But just a little more momentum to the downside, and we break through that bullish divergence like we already have here on the RSI. Now, on the RSI, it is worth pointing out, let me just go back, let's say 3 years, that we are now in some pretty serious oversold territory, okay? The last time we were oversold was right ahead of this bounce that we got right here that made our bear flag. It touched it right here before it bottomed significantly back in July of last year. Touched it back in here with a very bullish setup because we had two touches with bullish divergences on both of these. And that was essentially the beginning of a rally that lasted well over a year. Here we were back in September of 2022 at the end of that bear market, and this is what we were signaling as well at the time. These are markups from that time, and you can see that oversoldness and a bullish divergence right here gave us the beginnings of a 2+ year rally in stocks with some volatility along the way, right? If I go back further, you're going to find more of that. Here we just didn't quite get into oversold territory. That's why the dotted circles, but we got close enough for a rally and so on. So again, the short-term setup is for a rally, but I don't know that it happens in the massive fashion that I expect without something solid and convincing coming out of Washington that there's going to be a different tact going forward, or that the current tactics are working and these tariffs will not be long-term affairs. So the market is short-term ripe for a rally, and we're not going to get it, at least not unless something changes between now and the open tomorrow. We could get it intraday tomorrow. We could get it sometime next week, or this market can keep going lower for a while. So one of the things I think people are hoping for is that the Fed will step in. In fact, the president last week was saying, quote, Jerome, it's time to cut interest rates. But also last week, the man spoke, Jerome Powell, and he intimated that they think the tariffs are going to be destructive for the economy. But there's also an inflation aspect to them, obviously, that they do, almost by definition, mean higher prices for things, right? So do they want to aggressively cut when we have an inflationary force, hitting the economy? Fed funds futures traders are saying, yeah, they will be cutting, right? Basically, they're pricing odds of a rate cut at the May 7th meeting, 2 cuts by June 18th. If we go all the way down to the end of this year, right now, the market is pricing in 5 rate cuts by the end of the year. So what does that say? That says that Fed funds futures traders think a recession is coming based on everything they know right now, and that is there's going to be this very aggressive trade policy that will force the economy into recession. That's essentially what this is telling us. If the Fed cuts interest rates 5 times between now and the end of the year, we are either in recession or barreling there in a hurry. Another one of our indicators is the 2-year Treasury yield versus the Fed funds rate. And, we like to show these things during times of expansion and times of recession. These red areas are recession. And you can see that it's not unusual for the 2-year Treasury, like right in here before the Great Recession, to consolidate after rising, come up, touch that before rolling over. The point here is that the 2-year Treasury is below the Fed funds rate and moving lower as we speak. So what does that denote? Well, that denotes expectation in the markets that the Fed is going to be cutting interest rates. And here is the opposite. Here's the 2-year anticipating Fed rate increases, and it got it right on the money. Here it is anticipating Fed rate increases, and it got it right on the money. Same thing. Here it is anticipating Fed cuts, and it got it. Here it was anticipating Fed cuts. Now, it did. The economy kind of held up, and then it rolled over, boom. It did. The economy, the 2-year kind of held up, and then it rolled over, boom. So this is just a visual that is looking like it does right ahead of recessions in the U.S. when you take it back historically, right? Up, rolls over, recession. Pierces through a couple of false signals right in there. Little tiny false signal right in there, something more convincing right in here again, rolls over, and then actually this time it actually came back with some optimism right before, the tech bubble burst, and so on. So again, this is an indicator worth respecting, certainly. I mentioned the yen. Here's what it's done so far since it opened today in the futures market. This is the dollar versus the yen, by the way. So this is the dollar going down and the yen going up. And I mentioned yields, which let me just update you on that. Yeah, the 10-year Treasury bond yield right now looks like 3.8%, which is 2.6% lower than it was on Friday. And again, back here on the S&P 500, at least on the daily chart, you can see we have a nice setup for a counter trend rally, if indeed the trend is lower right here going forward, which we suspect it is. Here's one reason, at least technically speaking, why we think the market probably has further to go. So remember, I said you don't want to have a sell signal on the monthly MACD from these lofty levels, right? Typically, when you do, you get more than, I think right now, probably a 15% decline off the peak. I think 13 or 14% year to date. This was 27% peak to trough in 2022, coming off of overbought levels. We never did get oversold, and we haven't since the bottom of 2008 and the bottom of the tech bubble bursting. But typically, when you break the uptrend and then the negative momentum kicks in, you get something more than we've had so far. And again, it's a long ways before the market is oversold, at least on a monthly basis. But it certainly is on a short-term basis, which is that daily chart I keep showing you. So folks, again, as I said a couple days ago, been here before in terms of these patterns, in terms of living through economic weakness, understanding what the market does, knowing how to stay hedged to mitigate. We are not going to avoid the downturns as we saw on Friday. The point is to, like we managed around COVID and around the 2022 bear market, as for two examples, and that is to mitigate it, capture less of the ultimate decline. And in this case, we think be in a real good position to take advantage of great values globally as they materialize. So folks, I'll leave it there again. Who knows what the market's going to be doing by the time you receive this, but no doubt, as I said the other day, I'll be back much more often while this kind of volatility continues. Thank you as always for watching and listening. Talk to you soon. Bye-bye.